If you're sketching out a summer road trip or just budgeting for your weekly commute, you're likely staring at these numbers at the pump and wondering how they got so high. That strain isn't stopping at the gas station. Airlines are paying significantly more for jet fuel, which is why they're quietly reducing flight schedules and even cutting back on complimentary in-flight snacks. So why is the cost of basic transportation suddenly spiking right as we head into the summer travel season? The personal financial squeeze you're feeling is the final local ripple of a massive disruption in the global energy market. The root of this current chaos traces back to late February, when a war between the US, Israel, and Iran erupted in the Middle East. The outbreak of that specific conflict immediately triggered supply fears. Energy traders, worried about a sudden drop in available oil, began panic buying. This chart shows the price of Brent crude, the main international benchmark for oil. You can see prices surging 37% since the war began, briefly trading above $126 a barrel last week before settling near the $100 mark. A localized conflict has pushed the global supply chain into a state of shock, which translates directly to higher costs for everyday households. While consumers are paying a premium, someone else is collecting it. And right now, the biggest collectors are European energy conglomerates. Shell's first quarter profit soared to $6.92 billion, more than double the previous quarter. BP mirrored the success, doubling its quarterly profit to $3.2 billion. Total Energies reported $5.4 billion, using it to double share buybacks and raise dividends. The industry knows exactly why this is happening. Shell's chief executive, Wael Sawan, stated these returns came amid an unprecedented disruption in global energy markets. In the mechanics of the global oil trade, consumer panic and sudden supply shocks function as highly efficient revenue generators for foreign energy giants. But when we look across the Atlantic at the two largest American oil producers, ExxonMobil and Chevron, we see a glaring financial contradiction. This graph tracks American oil earnings during that same high-price period, and the lines go in the opposite direction. Exxon's first quarter earnings dropped 46%, and Chevron slid 37%. To understand this paradox, we must look at how these companies report their math. These declines are largely due to what are called paper losses, accounting artifacts that are expected to unwind in the coming months, rather than a failure to sell oil at high prices. Even with high prices at the pump, Exxon and Chevron have made a significant strategic decision. They have no plans to increase their oil drilling to take advantage of the current market. Exxon and Chevron are holding oil production steady, opting not to ramp up drilling even as gas prices climb. This strategic choice keeps the global supply limited, prolonging the pressure on the market. This disparity, high consumer prices alongside massive corporate returns, is generating immediate political backlash, including renewed calls for a windfall tax on oil profits. We have seen this cycle before. These demands mirror the response that occurred when energy companies benefited from higher prices after Russia's invasion of Ukraine in 2022. The International Energy Agency is already mapping out the long-term impact, officially lowering its forecast for global oil demand for 2026 as reserves are tapped to manage the current chaos. The physical geography of our supply chain makes the situation incredibly fragile. The Strait of Hormuz, seen here, is a narrow shipping lane that bears the brunt of these regional pressures. The IEA has issued a stark warning regarding these choke points. Even if they were to reopen immediately, the world must brace for significant supply disruptions for months to come. The interconnected global energy market is built on profound geographic and political vulnerabilities. When distant shocks occur, the system reliably funnels wealth upward to the producers, leaving everyday people to pay the